Hello everyone, welcome back to my YouTube channel. Welcome into Accounting with Oscar. In this video, I'm going to be continuing my discussion on the February-March 2025 IGCSE Accounting Paper 2, right, question 2, where we'll be looking at how to prepare a income statement as well as parts of the statement of financial position. So in question 1, we've actually had a look through some journals and ledgers, which they were fairly straightforward, nothing too complicated. Now the same goes for this question actually. For this question, it's quite straightforward as well. There are no traps here if you know what you're doing. There are no traps. It's gonna be a very doable question. It's really easy to score on this. You could easily hit about 15 marks if we do this well. So let's have a read through here. Now, Viraj is a retailer. He buys on credit and sells for cash, right? So kind of like a supermarket. So he rents out an area of the shop to another business for $172 per month. So the first thing I'm going to point out, this is your rental income, right? You're renting out your shop to someone else for $172 per month. So how much do you get in a year? Well, I know they've not asked us for anything, but when I see something like this, my mind becomes conscious, like I probably should do this. I probably should calculate this. I don't know if you feel the same way, but that's how I work. So when I read through things and I see like certain keywords, my mind automatically tells me this is what I have to do. Well, I think that's after like years and years of practice. I mean, I've been lecturing accounting for God knows how long, so right, $2,064 in a year. Right, so Viraj's trial balance at 31st January 2025 is given to you. So you have details on revenue, rental income, sales return, inventory at 1st February 2024. This marks your opening inventory. Right, we have information on purchases, rent and insurance, general expenses, wages, stationery and advertising, bank charges, fixtures and fittings at cost, the accumulated depreciation of fixtures and fittings, trade payables, bank overdraft, capital, and drawings. So with all the information given here, we're gonna look into some adjustments that we have to make. So don't forget to read this piece of information, because this information here, the 5 notes here, they are going to contain some adjustments that we're going to have to do to the trial balance above. So the first information they've given us, inventory at 31st January 2025 was valued at $5,900. Now, what is this? This is your closing inventory, right, at the end of the financial year. For the second note, depreciation on fixtures and fittings is to be charged at 15% per annum using the straight line method. So straight line means we're going to depreciate on cost. So let's do that now. Where is our fixtures and fittings? Yes, right on top. So I'm going to calculate a 15% depreciation. So multiplied by 15%, that's 1,875. And I'm going to make a remark here that this is going to be part of my expense later on. Right, it's a part of my expense, 1,875. Now for note number 3, rental income included in the amount due for the period from 1st February to 30th April. Alright, so rental income included the amount due from 1st February to 30th April. When is our financial year end? 31st of January, right? That means we have received prepaid income, right? This is our prepaid income. So we have not earned the rent yet, but we receive it in advance. So February, March, April. There's gonna be 3 months there, right? It's gonna be 3 months. So what I'm going to do is I could do a prorata, I could multiply, or what I could do is I'm gonna take 2,580 and minus the initial rental that I calculated earlier. So the balance of 516 is going to be my prepaid income. Okay, so since this is a prepaid income, what do we recognize? A current liability. Why is it not a current asset? I'm sure some people are going to say that, right? It's a prepayment. Shouldn't it be an asset? Well, you have to look into the point of view. For this case, we are looking at rental income. So I receive something that I have not earned yet. Does it belong to me? No. It means that I owe you my place for another 3 months. It's my liability. I've not earned the income, but I receive it from you in advance. So that's where it turns into a current liability. So that adjusted, we're going to move on to note number 4. At 31st of January 2025, Viraj owed $282 for wages and $55 for advertising. So wages and advertising, these are expenses, right? These are my expenses. And I owe this amount. That means I've incurred, but I've yet to pay for them. So what I'm going to do is I'm going to go up again and make my adjustments. We're going to go to the wages account. Where's my wages? Right here. And I'm going to add in $282 because that's what I owe. It's not been included here, so I'm going to park it in. So this will give us 7,632, am I right? You know what? I have a calculator. Why not make use of that? So, yeah, 7,632. And how much are we owing for advertising? 55. So let's go up to the stationery and advertising at 55 here to get 765. So I'm going to put a note. These are my current liabilities once again. I've incurred, I've used it, but I've not paid for it. Okay, so adjustment 4 done. We're going to move on to adjustment number 5. After the trial balance was prepared, Viraj received a bank statement which showed that bank charges of $13 had been paid in January 2025. So the bank has charged me for using their service. This is an expense. I'm going to go up to the bank. Do I see my bank? Yes, I do have my bank charges. I'm going to add $13 there. So that becomes 156. And at the same time, I'm going to adjust the bank overdraft. So we're going to add $13 to the overdraft right here. So that's it. That's all my notes settled. So this is how I usually attempt a question like this. So before I go on preparing the income statement or the financial position, I would first read through the notes. I would see what are the information they've given me, and I will make an adjustment straight away. I don't read through and then, I move on to the income statement. I come across like, wages, then I start adjusting. No, what I do is I'll adjust straight away when I'm reading through the notes, because that helps me stay on focus and I become clearer on what I'm actually doing. So once all the adjustments are done, I'm going to move on to the next item, which is to prepare the income statement. Right? Prepare the income statement for Viraj for the year ended 31st January 2025. So I hope most of you are familiar with the format of an income statement. An income statement basically looks at the profit or loss that was achieved in the year. So there are going to be two components in the income statement. First, we're going to look at income. Second, we're going to look into our expenses. So for this case, I'm going to start us off by looking at the revenue, right? That's the first thing we're going to park into the income statement. We're going to look into revenue. So how much is the revenue? $89,600, right? So I'll tick things as I go along so I know what I've used and what I've not used. So 89,600, that is my revenue for the year. Now, before we rush into preparing the cost of sales, let me double check. Is there any sales return or return inwards? Yes, we do, right? It's the third item right here. So return inwards, 2,195. This return inwards is going to reduce your revenue because your customers return goods to you. So less sales return. Usually I put the brackets there just to indicate that this is a minus figure. So 89,600, get rid of 2,195, you get 87,405. That is your net revenue. So moving on from there, I'm going to work out the cost of sales. So the formula to calculating cost of sales would be opening inventory plus purchases less closing inventory. But before I fill that up, let me just double check if I have any purchases return or if there's any carriage inwards. Alright, so I think we have none of that. So we're going to park in our figures here. Opening inventory, 4,005. This was not sold last year, so we bring it in to this year to sell it. That's why we add it to the cost of sales. For purchases, I have $53,700. And the last component, closing inventory. So closing inventory is the stock that we have at the end of the year. We didn't manage to sell this off, so we take it away from the cost. So that's based on the matching principle. $5,900, right? Closing inventory given in note 1. So minus 5,900. Let's calculate 4,005 plus 53,700 minus 5,009. So we get $52,300. Now remember, this is a less, right? Less cost of sales. So we're going to deduct this figure from the revenue figure. So 53,200 minus 87,405. So I get a gross profit of $35,105. That is the first part of my income statement. So we call this the, let's get everything, yeah? So we call this the trading section of the income statement. So this is where we compute gross profit by using revenue less cost of sales to get gross profit. So that is part 1 of the income statement. Now I'm going to continue with part 2. So part 2 of the income statement is where I will bring in other income and expenses. So let's have a look here. Do we have any other income? Yes, we do, right? We have rental income. Anything else? No, so I think that's it. I'm going to park the rental income into the income statement. So rental income is $2,064 for the whole year. So we're going to come to gross profit. I'm going to put it right below at other income. So what's the other income I have? Right? It is my rental income, $2,064. Since it's the only other income I have, I can park it straight away onto the right side of the right column of the income statement. So 35,105, we're going to park in the rental income, giving you $37,169. We're not done yet because we still have the expenses to bring in. So let's go back up and fill in all the expenses. The first item that we have is the rent and insurance, $8,760. Now, my apologies because we're going to be going up and down quite a lot. 8,760, rent and insurance, we are done there. General expenses, 2,945. Okay, let's go back up. We have wages. Okay, wages, you gotta be careful. You gotta use the adjusted figure, 7,632. All right, and we go back up. We have stationery and advertising, 765. Wouldn't it be nice if you could just copy paste everything? Yeah, I know, that's what students like, right? Copy and pasting. Don't have to copy. You don't have to write everything down. So what's next? After stationery and advertising, we have bank charges, right? 156. Okay, anything else? Well, we did calculate depreciation earlier, 1,875. That's also one of our expenses, right? I've marked it here. So depreciation, 1,875. Alright, so I believe that should be everything. Let's double confirm. So the last item was depreciation. We have nothing else, I believe. So bank charges recorded, depreciation recorded. Yep, that's it. So I'm gonna sum up the total here of the expenses and bring it over. So do we get 22,133? Right, so it's less expenses. I'm going to minus this from the figure above. And we're going to work out the profit for the year. The moment of truth. All right, $15,036. $15,036. So we're going to label this as profit for the year. And there you go. There you get 9 marks. Not difficult at all, right? So you just have to make a little bit of adjustments from the notes, and that's it. You get your 9 marks. Well, provided you know the pro forma of an income statement, but again, fairly easy to score in this part of the question. So the second part that we've done right here, this is part 2 of the income statement. We call this the profit or loss section. So this is where we have our gross profit and we adjust for any other income as well as expenses. So there you go, right? There goes your 9 marks. Very beautiful. Rather straightforward, I believe. Alright, so moving on, I'm going to discuss part B of this paper. So part B, we've been asked to prepare the current liabilities section of the statement of financial position at 31st January 2025. So you don't have to go about preparing the whole statement of financial position. You just need to prepare the current liabilities section. So just an FYI, right? The statement of financial position, it measures the financial position, obviously, right, of a business. So to put it in layman's terms, we are looking at whether the business is healthy or not healthy, right? Whether it's high on cholesterol or not. Now, how do I decide that? So if this business has high liabilities, I'd probably say it has high cholesterol, it's at a high risk. But if you have high assets, then probably you're a very healthy company, very good. If you have high assets and low liabilities, you look attractive to people. You're like an attractive person walking on the street. So anyhow, in the statement of financial position, you're going to see 3 items. You're going to see your assets, both non-current and current. You're going to see your capital or equity section. And you'll see the liabilities as well, both non-current and current. Okay, so with that, let's get started. Since this is only a section of the financial position, we don't need to start with non-current assets and assets. We can go straight into current liabilities. Now, what's the first current liability that you see up here? So for me, I see the trade payables at $3,125. That is my first item. So I'm gonna park my figure in here. So I'm going to move on to the next item here. What's the next liability or current liability that you see? The bank overdraft, right? Okay, but I'm going to keep the bank overdraft for last. Let's go in the order of the least liquid to the most liquid. Alright, so what's the next item besides the bank overdraft here? Yes, we do have a prepaid income, right? Prepaid income and also some accrued expenses. So we're going to bring that all in. So I have my prepaid income as well as my accrued expenses. How much of prepaid rental have I received? 516, right? So I'm going to bring this figure down below, 516. And what's the total accrued expenses? 282 plus 55. So giving us 337. And finally, I'm going to bring in the bank overdraft because we have no other liabilities. So we bring in the bank overdraft. You should be using the adjusted figure, 1,273. So let's bring this up, 1,273. And we can do a sum up. And there you have it, 5,251. That is the total of our current liabilities. Again, very easy, very straightforward, no tricks here. The most common mistake you would make would probably be putting the prepaid income as a current asset, right, to some people. Or some people, you might have included the original bank overdraft without adjusting for the bank charges. But other than that, it's fairly straightforward. So I hope at this point you guys and girls are doing alright. I hope you've gotten something out of this. Hopefully. Right? I mean, if I've inspired you some way or another, yeah, just drop me a like, or, share this video with your friends. I don't mind. Share my videos. Let's try to help as much people as possible. Right? So that's my current liabilities section. And I'm going to move on to part C now. If you think I'm going too fast, you could always leave a comment, then I know when I can slow down. Or if you've not copied in time, feel free to just pause the video, you can just freeze everything nowadays. Yeah, so let me bring you on to part C. Now, part C, this is a question that, again, I have two fan bases here. Either you're gonna like this or you hate it, right? It's either a love or hate relationship with accounting principles. I had my fair share. I had students who loved this topic because it made a lot of sense and they love to, think about all these accounting principles, how they apply, how we adopt them. But again, I have another group of students who may not like this a lot because you have to understand, and to some people who do not speak English as their mother tongue, they get stuck a bit with the words, trying to remember the words, trying to remember how to spell things, right? But anyhow, we still have to answer this if you want to get your 2 marks. Your 2 marks could be critical. So state the accounting principle which Viraj has followed when he did not include a figure in his statement of financial position for, number one, his inventory of price labels, right? The price tags that you see. And number two, his skills as a salesman. So to be able to answer this question, you have to know your accounting principles, right? You have to know your going concern. You have to know your business entity. You have to know what is materiality, what is consistency, what is duality, what is realization, right? What is historical cost, what is money measurement. So you have to know each of those terms in order to get through this. So in case you've forgotten, I would like to do a quick revision on accounting principles, if you may. If you find I talk too much, fine, go ahead, you can skip this, alright? So for those of you who need this is where I'm gonna try to help you out. Let's talk about the first accounting principle. Right? I go with something easy. Can I start with business entity, right? Let me talk about business entity. The accounting principle of business entity states that the owner and the business are separate, right? The owner and the business are separate. I am me, right? You are you. Both of us, we are separate. Owner is the owner. Business is the business. We don't mix ourselves up. So, how do you demonstrate business entity? For example, if I withdraw goods from the business for my own use, what should I do? I should record drawings, right? So I make a record that I owe the business. I record my drawings. So that's an example of business entity. The second accounting principle I would like to talk about is going concern. Now, going concern, this is technically an assumption, right? It's an assumption that the business will continue to operate for the foreseeable future. This means that the business will continue in operation. It's not expected to close down. So if we apply the going concern principle, we would value our non-current assets at net book value rather than a for sale value. Okay, that's how we apply going concern. Right, besides this, we also have the concept of materiality. So materiality states that only items which are material are recorded in the financial statements. So if something is not material, we don't have to put it in. For example, I could purchase a stapler, right? I could purchase a stapler. This stapler could be used for, many months, many years to come. Could last for 10 years, longer than your relationship. Sorry, guys. But yeah, a stapler could last for 10 years. But do we categorize it as an asset? No, we don't, right? I don't say my stapler is my asset and I depreciate it every year because the value is too low. It's not worth my effort trying to depreciate. Right, besides this, we have the money measurement concept. Money measurement states that only items which can be expressed in monetary terms are recorded. So if it's something that you can't put a value to it, then we probably don't record it into our financial statements. Say, for example, I have a very famous customer, right? Maybe I have Obama as my customer. Now, how am I going to put a value to that? Am I going to say that my business is worth billions of dollars just because Obama is my customer? Well, may not be fair to say so, right? He's not going to splurge his entire net worth on you, so it is difficult to find a value to that. So I don't put in like customers as my assets or my employees as my assets because I can't put a value to it. So the next accounting principle we have is duality. Duality is a very simple principle. It states that every transaction, right, every accounting transaction has two entries. So that's why you have one debit and one credit, basically applying the double entry principle. So the next item on my list, I'm going to talk about consistency. So the consistency principle states that we should apply similar accounting principles or similar accounting policies from year to year. So we don't simply change an accounting policy just for the sake of changing it. So, for example, applying the same depreciation method every year, or maybe consistently providing for doubtful debts every year, right? That's an application of consistency. So, what else have I not covered? Let's have a look through one more time. Business entity, going concern, materiality, money measurement, duality, consistency, right? One more. Let's talk about historical cost. The historical cost concept, right? This is where we record a transaction at its original value instead of the market value. So recording a transaction at its original value. So for example, the business would have bought a property 30 years ago. That property initially cost 80,000, right? For example, it was 80,000 when you buy it 30 years ago in 1995. 90 kids, do you feel old yet? Okay, so today, in 2025, the same property might be valued at 2 million, right? But if I apply the historical cost concept, I'm going to stick with 80,000. I'm not going to change the value of the property to $2 million because that would be the market value. And I'm not using the market value, I'm following historical costs. Right? So these are all your accounting principles. Now, coming back here, state the accounting principle Viraj follows when he does not include a figure for, number one, the inventory of price labels. So imagine this as the little price tags that you see, right? The little price tags that you see. Now, we have the price label. Why don't we put it as an asset? So if you said materiality, you are correct because the value is too low. It's not worth recognizing this. And number two, his skills as a salesman. This is an application of money measurement. Congratulations if you said that. So the money measurement concept, because these skills cannot be measured in monetary terms, it's difficult. Right, I can come up with any weird or any skills at all. I can tell you that I can drink a gallon of milk in 5 seconds, right? How much is that worth? I mean, when are you going to use that skill, right? Or maybe I tell you I can change a tire in 10 seconds, right? I mean, Well, what is that, right? What does it bring to the table? And what is the value behind that? So, some things they can't be expressed in monetary terms. Yes, so that is the money measurement concept. And once again, we've come to the last part of the question where you're gonna face your nemesis again. We're gonna look into some theories, right? Now, this theory here is, again, fairly simple. It's not difficult at all. You just need to apply a bit of logic and a bit of common sense. So, Viraj wants to refurbish, probably he wants to renovate the shop. He thinks that the new... Oh, sorry, I think... is there a case study up there? No, alright. So he thinks that the new fixtures and fittings would cost between $10,000 to $15,000. There are several local shops selling the same type of goods that Viraj sells. So this sentence here is in fact emphasizing on competition, right? There are other shops in the areas that sell the same product as you. So these are your competitors. Alright, so the requirement here is to advise Viraj whether or not he should refurbish the shop. Justify your answers by providing 2 advantages and 2 disadvantages of Viraj refurbishing the shop. So once again, I'm going to give you in point form because if I write, it's going to be very messy here. So let's talk about this, right? What's the advantage if you choose to renovate your shop? So logically speaking, number 1, I may gain a competitive advantage, right? I might have a competitive advantage over other local shops because, well, I renovated, my shop looks good, it's new, it's clean, lighting is good, people love coming in here. So I actually have some benefit. I have a competitive advantage that others do not. So this, what happens? It may attract new customers because my shop looks nice, it looks new, people are excited to see what has happened. Okay, what else can you talk about? What other advantage could you think of? So some people would say there's a possibility to increase prices, right? There's a chance we could increase our selling prices because we've renovated the shop, everything looks good. Some people may pay higher prices for a more premium environment. Right, why do some people pay for toilets, I mean, there are public toilets, but some people, they choose to pay to enter a toilet, premium toilets. It's all because of the environment. So, I mean, we can't say that, no, people go for cheaper stuff. Some people want the environment. So, it is a possibility you could increase your selling prices. So, while you do that, there is also another possibility to increase rental income, right? Remember, we are renting out a part of our shop to someone else because we have the extra space. So there is another possibility that we could probably increase the rental of the shop because we have new furniture, we have new tiles, new lighting. Yeah, so we could get in on some extra income, on some extra cash. So let's move forward to our disadvantages. The first disadvantage about renovating or refurbishing the shop, what are you gonna say? So I might say that customers may not care too much. Right? Customers may not care too much about the fixtures and fittings, or you can say that customers may focus more on prices instead of environment. Another point that we can take note here is that the business currently has an overdraft, right? We do have a bank overdraft. So if I purchase new fixtures, new fittings, what's gonna happen? We are going to stress out the current overdraft. So you're overdrawn by $1,000. If you're gonna continue refurbishing, your overdraft is gonna be crazy high. And that's where you have to that's where you gotta pay overdraft interest, right? Pay overdraft interest, or probably you have to pay loan interest if you decide to borrow a loan from the bank to finance the refurbishment. So there's also one more point here, and this is actually a good point that most people may not see, right? Most people may not see this point, and I'm going to point it out to you. Can you have a look into the provision for depreciation of your fixtures and fittings? Do you see this figure here? 3,750? Now, how many years have we depreciated the fixtures and fittings? Only for 2 years, right? That means your current fixtures and fittings are only 2 years old. They are new, right? It's still new. It's only 2 years old. You don't change a car after using it for 2 years. So why are you changing your furniture after using them for 2 years, right? So I could mention that the existing fixtures and fittings are only 2 years old and still new, right? I mean, you're not using them for 20 years, so why are you changing them after 2 years, right? But of course, this is a higher level of analysis. I know most of you wouldn't have seen that if I didn't tell you, so it's alright, right? You don't have to prove to the examiner you have critical thinking skills. You just have to, by stating the top 3, it already shows you have critical thinking skills, right? You don't have to show them you have very detailed analytical skills. You don't have to prove to anyone. So as long as you're able to give me relevant points, you already win, right? Because that shows you're able to think, that you're able to generate ideas, and that's good enough. Alright, so I'm gonna end this video right here. We're gonna take a break and we'll probably come back for question 3 some other day, alright? So thank you all for watching. Make sure to like, share and subscribe, and I'll see you in the next video.